Welcome one, welcome all to the node. I am Mike, aka Veteran Crypto, and hopefully David, my co-host, will join us here soon. But if not, the show must go on. So, gonna go ahead and jump into right off the bat. We're gonna start with our news segment. So let me share my screen, and we're gonna start with DeFi Llama. There he is. All right, let's see. So we got DeFi Llama up. I want to start doing this on each of our shows, kind of just showing DeFi Llama, showing the growth, showing what's going on with DeFi and RWAs. But, a lot of people like to focus on price and price only. And that's what, the emotional trigger that a lot of people base a lot of their decisions off of, which, as you know, if you watch the show, me and David are always preaching to, get rid of emotion in your investing. It will wreck you. It will be what the, kind of the big money does to manipulate you. So, David, do you have any input on, on some of these charts as far as, like TVL, and I can throw up some other stuff too, stablecoin market cap. But I want to just really very quickly point out the growth. While these prices are dumping, and we're seeing some positive price action this morning, but while these prices have been going down over the past months, we've seen a continual growth, overall in DeFi and RWAs. What's your take on it?
Yeah, so I think, Mike, that mostly what we're seeing in the RWAs, mainly on Ethereum chains, is treasuries. We're seeing tokenized bonds, tokenized bills, tokenized U.S. Treasury assets of different types, and they're not made equal. There are many different. I guess you could call them just RWAs, but tokenized treasuries, and they all have different terms. Many of them will pay a yield, but that yield might accrue to the token price. Some of them pay a yield where you actually get more tokens. Many of them you can't actually invest in unless you're accredited. So, that means you've got to have a significant net worth. And, so a lot of the minimums for some of these products are like $100,000. That's like the minimum that you can invest in some of them. Many of them have some pretty high fees. Because if you're swapping into something and you're planning to earn, the treasury yield, maybe like the 10-year treasury yield or something like that. And if I'm taking a look at my other screen here and just looking at yields on the 10-year, we're sitting at 4.05%. So if you're planning to earn, let's say 4%, swapping into these, RWAs on Ethereum chains, but you've got to pay a fee. There's like a performance fee of like 0.20%, so 20 basis points. And then maybe like some type of swap fee of like 10 basis points. Like that adds up quick. So you got to be really conscious of which company's product you're swapping into.
Yeah.
You got BlackRock.
It's almost like tokenomics, understanding those underlying fees, understanding how, how it shares the revenue with the asset holder, all those things that we're always preaching about.
100%. Yeah. So for me, those treasuries on chain, it's very, very small, like the amount of products that you can actually trade is very few. There's only like 2 or 3. You might see that BlackRock's BUIDL, has well over, what is it, a couple of $1 billion TVL or something like that. And while that, well, how big is that one?
BUIDL, let's see. Let's actually look it up. There we go. So this is the BUIDL fund. It looks like 2 billion, like just shy of 2.2 billion. Or
Yeah,
sorry,
so that's 2.2 billion. Yeah, so that's actually really small.
Yeah.
Yeah. And you can't really trade this thing. So it's really hard to swap into it. If you actually wanted to get exposure to tokenized treasuries You've got to take a look maybe at, I think Open Eden has a product that
Mhm.
you can actively swap into. Circle has a product also. I think it's USDY, I think. But they charge a ton of fees. And I think that there might also be like a lockup period of some type. Um, oh, so USDY is Ondo's product. Got it.
Yeah.
Yeah. So Circle's got a product, Ondo's got a product, and Open Eden has a product. Those three you can actually swap into. But all the rest of them, although they have a lot of TVL, you can't really trade them. So you can't really use them for anything unless you're accredited.
Did you mean USYC?
That's it. USYC. Yep, that's the one.
So it's about 1.8 billion is what's in that. Majority of which is on BNB chain. It used to be Ethereum, and it looks like they've been moving that over to BNB.
That's actually kind of interesting.
Yeah,
I
it
wonder
is.
why. I wonder why.
We'll have to dig into that.
Hmm. Yeah, that's kind of strange. They must have made some type of a deal with Binance, I'm assuming, in order to be able to do that.
Yeah, yeah, especially since Circle works so closely with Coinbase, and who of course is kind of the not the curator, but kind of the meat behind the base chain, which is on Ethereum. It's a layer two on Ethereum.
Yeah.
Yeah,
So, and as far as the BNB chain goes, I think BNB has been attracting a lot of stablecoin assets recently. So you've got the Trump family with their product, World Liberty Financial. Um, it looks like World Liberty Financial is it some type of a hedge fund almost, like a fund that buys digital assets and then mints stable coins. I think that's basically the route that they're going with that. Isn't all of that it's USD1, right? The World Liberty Financial stable.
yes, yes, it is.
That's all on, isn't most of it on BNB chain, I think. A large portion of it.
Let's check that out. USD1 World Liberty Fi. So that is. It looks like mostly on Ethereum, but it looks like BSC is the second largest.
Got it. Yeah. So I mean, those are both EVM chains. So Ethereum, Binance Smart Chain. Looks like they got some, about $1 billion on Solana. Uh,
Yeah,
Interesting that there's something on Aptos. Cool.
a little
Hmm.
bit. Yeah, a little bit of. I've never even heard of Abcore.
Yeah, I think Abcore is some type of EVM layer two. I think.
Oh, okay, okay.
Yeah, pretty sure. But yeah, but what can you actually do with this one, with the USD one? Are there any exciting yields out there?
I haven't honestly looked into it. I have been avoiding pretty much anything investment wise that Trump is involved in after his meme coin fiasco and his wife's meme coin fiasco, where they just sucked a massive amount of liquidity out of the markets right when it was we were starting to see some really good price appreciation in the markets. It just everything just it was like a freaking black hole. It sucked all the fucking liquidity into. It got run up, and as it was running up, the smart people were sucking their money out, whereas most of the people that wanted to support Trump and stuff like that held on to it like it was a trading card or something. But
Yeah.
yeah, I've just avoided anything World Liberty Fi, USD1 being one of those ever since.
No, I hear you, Mike. And here's the thing, though. Like, it looks like a legitimate business. Like, it's not. A lot of people say that. Well, look, of course, I don't think that Trump should have launched a meme coin. I don't think that was a good idea. I don't think it was a good look. He and the first lady launching coins like that. So many people got hurt on that.
Yeah.
When they crashed, that I just don't think it was a good idea.
Well,
Um,
especially since he was supposed to be the crypto president and was going to usher in legislation and all that. So he should have just stayed. I forget what the term is, but basically agnostic as far as involving himself financially in the markets. Like he shouldn't have invested anything. Just like me and you believe that they shouldn't. People in positions of power that are drafting legislation shouldn't be investing. They shouldn't be allowed to basically insider trade with if they know a bill is about to come out or about to be signed or about to be drafted. That's going to affect the value of a stock. They are able to legally invest in it and or
Yeah,
sell
yeah.
buy. And so I agree with you. It was not a good look for him to launch a meme coin and do any of that. He should have just focused on pushing legislation through.
Yeah, he didn't need to launch the meme coin. He didn't need to do that. And, but World Liberty Financial, in my opinion anyway, it looks like a real legitimate business. And World Liberty Financial is basically brand new, but they've already launched more products than XRP Ripple Labs, which is kind of funny. Um, but it's basically the stable coin. They've got like a nearly $5 billion TBL stable. So, I would take a look at maybe using the USD1 stablecoin in DeFi in some way, especially if there are interesting yields on the BNB chain. So that might be interesting. But yeah, I don't think that he should have launched that meme coin. Not
Yeah.
at all.
Well, and don't get me wrong. I don't think World Liberty Fi and USD1 is a scam or anything like that.
No, 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 no.
It's more of I'm on my moral high horse. I don't want to and that's emotion. I should work on that because I just don't want to support something that I feel was a net negative for crypto in general. But anyway,
Well,
want to jump in the news?
yeah, man. Well, we've got some net positives today. I see
Yes.
Bitcoin up 5.5%. Yeah, what's going on?
So in crypto, our first headline: Bitcoin trades around 65.5 to 66K amid ongoing Mid East conflict, showing extreme fear. So those of you that don't know, there's a little something going on over in Iran. They took out the Ayatollah Khomeini, and the people are celebrating in the streets. They're waving the
Yes.
American flag, the Israeli flag. They're grateful because they've been under the boot heel of that regime since what was it, the 70s? That
Yes. Yeah.
basically the royal family at the time was taken out, and to be honest, the U.S. had a part in that. And then the Ayatollah took over and has been and it used to be that country was a beautiful place. Women had rights. They went to university. It was like the West basically. And then the Ayatollah came in. Women weren't
Islam.
allowed.
And
Yeah,
then Islam. Ah.
and so basically the summary is Bitcoin dipped to around 65.3 to 65.7 early Monday after weekend strikes on Iran triggered liquidations and risk aversion. With the fear and greed index hitting a 10 or extreme fear, it has stabilized near 65.5 to 66K, despite broader market pressure showing relative resilience compared to equities at a 24/7 asset. On-chain data shows, and that's something to important to understand. Bitcoin can be traded 24/7. It's not like the stock market that can only be traded, as of right now, traditionally, 9 to 5, whenever the stock market's open. So, Bitcoin and crypto is, price is affected 24/7, 365. So it's a very good litmus test or a finger on the pulse of potentially what could happen to traditional markets once they open on Monday. So if you see a bunch of stuff going on like it did on this weekend, and you see Bitcoin getting hit, it can give you an indication or a data point potentially as to how stocks are going to behave first thing Monday, when the market's open.
Yeah, but you know what? It's still a bear market. And so what we're getting right now is referred to as a bear market rally. And I mean, look, I would love to see markets continue to rally simply because I will sell them. I'm, I'm just going to sell it if it keeps going higher, man. And that's what I've been doing this morning. I got filled on some more calls, sold some more calls this morning, and you know, look, I don't think anything has changed, and I don't know why markets have pumped, but I don't need to know why. That's the thing. Like
Mhm.
the why doesn't matter. The only thing that matters is price, and
Yeah.
price went up today. So, okay, what do I do? Well, I've got a bias. I've got a
Mhm.
market bias. I think that we're in a bear market. I think that over the next several months this year, Bitcoin moves down towards maybe 50K or a little bit lower potentially. And so that means that if Bitcoin bounces, I should be a seller of that bounce. And it
Mhm.
doesn't matter why. The reason why it bounced, look, no one's ever going to know why. Um, I'm reminded, Mike, of my mentor in options trading, Tom Sosnoff. He used to talk about when he was trading in the pits in the CME in
Yeah.
Chicago back in the day. They had TVs up on the screens, or they had TVs up, right? So they had the TVs playing news, and then they had the boards. So
Mhm.
when you hear that phrase like what's the best looking stock on the board, it's because they had these big boards where you could see quotes for all sorts of everything. So
Yeah.
what Sosnoff would say is that the price would move before the news.
Mhm.
So I don't think for most news events, they really have anything to do with pushing price around. I think
Mhm.
really it's just that people like us like
Yeah.
to ascribe that, to a piece of news, like, hey, that's the reason why price moved. We say, oh, well, because that piece of news happened so close to in time to the price moving, that must have been the reason why. And I think for the most part, it almost never is. So for me,
I
I'm
almost think
just
it's a
yeah,
gamification. I think that big money understands that they can use news to move to move price. Just because most retail is emotional, and if they see war, they're like, oh, okay, well, these stocks are going to be negatively impacted in their mind, and these stocks are going to be like if they're they have to do with the war effort, or if they have to do with building missiles, or it's those stocks are going to rally because people attribute certain companies to being bullish during times of war, or being bearish during times of war, or tariffs. If they see tariffs are coming, they're like, oh, okay, price is going to go up on everything because of tariffs. They importing from overseas. Um,
the
but
tariffs are coming. The tariffs
yeah,
are coming.
no, I think it's important that people understand that, and why it's so important to sit on your hands often. Unless you're trading short term, if you're investing in assets, long term, because you understand it's a good product or it's a good company and it's run well, and the services they provide are top notch, like Amazon. Then oftentimes just buying and sitting on your hands is the best strategy. Now, there are some very volatile assets out there that you can trade short term. There's some cryptos that are like that, have very large swings. And if you're, doing, scalp trading and things like that, it's very easy to, if you just say, hey, like David, I just want to get like 10 to 20%. And as soon as I get that, I'm in, I'm out. I'm not going to look for those 100 X's. I'm just like 10 or 20 on each swing. And you just make your money. And hey, you know what? I traded for a couple hours. I'm done for the day.
Right.
That's how a lot of the best traders are.
Yeah, so Mike, for me, it's really not about our markets going up or our markets going down or our markets moving sideways. Are they moving in circles, backwards, left, right? It doesn't matter. All that matters is if I form a thesis, if I form an opinion about the markets, how can I, take advantage of that opinion? I've got to have some type of an edge that I can exploit. If you don't have an edge, you can't trade.
Yeah. All
Check it
right.
out,
Well,
man. What's going on in CoinDesk?
yep. Next story up is Strategy purchased more than 200 million in Bitcoin last week. The latest purchase, funded through common and preferred stock sales, lifted total holdings to 720,737 coins, valued at more than 47 billion. So I'm going to go ahead and summarize this. So MicroStrategy acquired 3,000 Bitcoin last week. 67.7 is their average. Funded by stock sales, boosting its holdings. This continues an aggressive accumulation strategy despite market volatility from geographical events. Shares remain flat in early trading. One thing that is important to understand, though, is the dividends that they are paying from owning their stock went up. So that is very bullish if you own, MSTR stock. So
Hey, I really like Sailor, man. I really like what he's been able to do. He is brilliant. And that financial engineering that he's put together with that stretch token,
yeah,
STRC,
yeah,
you know, I mean, just having the foresight to be able to get in size and buy Bitcoin like this, brilliant, man. Really is. Um, so hey, I think that they've got plenty of cash on hand to be able to pay all those dividends. And I think that they're going to be able to do that for the next couple of years also. So as long as he can weather the storm, that's basically all that matters, right? He's just got to be able to get through this bear market.
yeah. No, I
Yeah.
absolutely. All right, next story up. Iranian crypto outflows surged 700% after U.S. Israel strikes. Outgoing transactions from Iran's largest exchange, NoBitX, spiked 700% immediately after weekend strikes, per blockchain analytics, indicating potential capital flight amid the escalation. This highlights crypto's role in crisis regions despite global volatility. So yeah, I mean that's kind of to be expected. Being
So,
an Iran,
so Mike, what was the name of that exchange?
it is called No Bit X. So NOBITEX.
No bit.
No No Bit X.
That's so funny, man. You will not have the Bitcoin.
That's
No
right.
bit.
No Bit
I got to
X.
get some more coffee, Mike. I'll be back in 10 seconds.
All right. Let's see. Over the
That's so
weekend.
funny.
All right. So NoBitX allows users to convert Iranian reals into crypto and withdraw funds to external wallets, offering a route around traditional banking channels. I'm surprised that this was allowed to operate. The exchange processed 7.2 billion in crypto transactions in 2025 and claims more than 11 million users, making it central to Iran's digital asset ecosystem. Um, Previous reports have detailed Iran's growing use of cryptocurrencies as a hedge against a weakening rial. I know I'm not pronouncing that right, but apologies. And a potential workaround to international sanctions, with U.S. authorities probing whether digital asset platforms have enabled state linked actors to move funds. This could be the capital flight from this platform because the regime might have been using it to as a workaround for sanctions that the U.S. and allies have been imposing on them, and so they might have been using this to basically move money outside of the traditional banking system. That's just
Yeah.
I don't have any evidence to support that, but it would make a whole lot of sense
Oh,
because
yeah.
it's, now that that regime is being toppled, all that liquidity is being sucked out. It kind of sounds like it might be people that have access that are, the rats, fleeing the sinking ship. They're grabbing what they can.
Trying to
But
get their Bitcoin. Yeah.
yeah,
Yeah.
and getting the hell out of Dodge. So interesting, very very interesting.
I wonder if maybe that has some impact on price later on today. You would think that if they were dumping or at least removing, so I want to make sure that I'm clear here. Were they just pulling are Iranians or Persians just pulling tokens off of that exchange, or were they swapping them for fiat or something and tracked on that exchange?
It was saying that liquidity was being sucked out.
Got it. Okay.
So that would suggest to me that it wasn't the people, it was the regime, and they were using it again as a workaround, for the sanctions, because they can't use the traditional banking system.
Right.
The U.S., with SWIFT and all that stuff, basically put a lock on that, and that's why Iran, Russia, North Korea, South Africa, Brazil, and a bunch of others were trying to do that. BRICS is they were trying to basically build out a new, kind of banking rails, so that the to kind of break the stronghold that the U.S. had on the global banking system, because basically the U.S. uses that as a lever against their adversaries. If they're not playing nice, then the U.S. says, okay, well then you can't play in the financial system, and so it's
Yeah.
yeah,
I don't know, man. I mean, I think that the Biden regime made a big mistake by using treasuries as a weapon,
yeah,
because if you're gonna do that, then every country or company that owns treasuries all of a sudden has to rethink that position.
yes,
Because if one day the regime in power says, hey, you know what, we really didn't like what you had to say about this guy or about that guy, and so we're actually going to seize your treasuries. Like, dude, that means that you don't want to hold treasuries. So like, if you're the treasury department and your job is to sell US debt to foreigners and to businesses and domestically, well then no one's going to buy it from you if they think that you could censor them. If they think that they could have their assets frozen if they buy treasuries simply because they said something that the incumbency disliked, well, then you're going to have a hard time selling those treasuries, man. So
mhm.
should not weaponize them.
No, absolutely, absolutely. All right, so next up, we got Bitmine Immersion Technologies reports a 9.9 billion in crypto cash holdings, heavy ETH staking. So Bitmine holds 4.47 million ETH plus Bitcoin and other assets totaling 9.9 billion, with 3 million plus ETH staked, generating significant yield potential via its upcoming MAVAN solution. This reflects continued institutional scale accumulation of ETH amid market uncertainty. So, a lot of this is kind of one thing that I think a lot of people miss is the accumulation that's going on. While price is dumping, these large institutions are accumulating in mass, and and a lot of people, obviously, they see things dumping and they want to sell because they're hoping to, buy back in at a lower price. Sometimes that works out, but sometimes it doesn't. Sometimes you lose exposure because you sell at the wrong times and you buy at the wrong times. So, what are your thoughts on this?
So yeah, Tom Lee. I like what Tom Lee has done, and I think that a $10 billion ETH position. Now, I'm really curious about what did you say in there, Mike? Maven. His there's some
Yeah,
staking solution.
MAVAN. They're upcoming.
What is that?
I have never heard of it. You want to look that up real quick?
Yeah, yeah. Here, let me see. I'm gonna hop on over here to Gemini. So it's called Bitmine Immersion Immersion Technologies, which used to be a Bitcoin mining company, by the way.
Yes. Yes.
Bitmine Immersion Technologies. What is the MAVAN
Yeah.
solution for generating yield? I'm assuming for
Yes.
generating yield.
So,
Okay,
so this guy is fast becoming the Michael Saylor of ETH. He's trying to
he's just
buy.
not as charismatic.
No, no, not as charismatic, and doesn't get as much attention, of course. But he is buying up ETH as fast as possible, and has been for a while.
Yeah, I think he was really responsible for that August 2025 pump in ETH. Really, like it was from the lows in March of 2025 down at like 1350. ETH got all the way down to 1350.
Yeah.
And I think he was responsible for pumping it up to 4900. And so I'm learning here about MAVAN, which stands for Made in America Validator Network. and it's a proprietary Ethereum staking infrastructure that's currently being developed by Bitmine Immersion Technologies. Okay, so it says it's designed to transform the company's massive digital treasury from a passive holding into an active income generating asset. So, Maven, so it's just the Made in America Validator Network. And it looks like they're just trying to, number one, stake their ETH. And then number two, they want to earn, wow. So he's got 3.7% of the supply right now. That's amazing. Yeah.
That's sizable.
It really is. And so it looks like the current yield on that, the 7-day annualized yield is 2.86%. So with over 3 million of its 4.47 million ETH currently staked, the company is planning to generate roughly $172 million in annualized staking revenue over the next 12 months. So that's not bad.
That's
Um,
not bad. That
you
sounds
know,
good to me.
yeah, and then he's saying that once Maven is fully deployed and the entirety of Bitmine's ETH is staked, management projects that the annual staking rewards could scale to over $250 million. That's per year. Wow, not bad. And yeah, so he's really
Well,
just trying to,
keep
yeah.
in mind as well as price goes back up, that increases as well.
I do recall Tom Lee talking about a way that he could apply leverage to that yield and turn that 2.86% yield into with a 5x multiple, like a 15% yield. I don't
Like doing
yeah,
a borrow lend loop.
I don't know, man. He was talking about something. I didn't quite understand what he was planning to do. He didn't describe it in detail. He just said that they could apply leverage to that yield somehow. Not quite sure how they would do that, but could be interesting to find out.
Oh, absolutely. Well, let's get into a little bit of DeFi. No, no, this isn't it. Hold on. Let's click on this. There we go. No, that's looks like they gave me the wrong link. Sorry about that. So, select DeFi tokens outperform in risk-off environment amid equities sliding and oil surging due to the Iran conflict. DeFi tokens like Jupe, Aave, Lido, and Morpho showed gains. Morpho's up nicely, and we're going to be talking about Aave and Morpho here in a bit in our educational portion of the show. With CoinDesk's DeFi Select Index positive over the past 24 hours, unlike broader smart contract indices. This suggests speculative appetite persists in DeFi protocols despite global caution. What what are
Yeah,
you,
well,
what are you seeing?
I think that markets have been down for months, and today is just a bounce. That's what I think. It's a great bounce, don't get me wrong, but to try to say that it means that these money markets and DeFi protocols and all these tokens are suddenly much, much more valuable. Um, I just don't see that. I think that all of these protocol tokens are probably still very overvalued because I just don't see the cash flows. That's the thing. That's the thing for me is these protocol tokens.
The cash flow, like as far as like the revenue earned, like from fees on
Right.
the platform. Okay,
Right. Yeah. So those protocol revenues, they need to flow back to token holders in some way.
yes.
And for the vast majority of these protocol tokens, they simply don't. So if we take
Well,
a look,
I know
maybe
Uni is starting. Aerodrome does a decent job of it, but I mean, does Aave and Morpho? I don't think that other because like even on the Morpho platform, there really isn't a way. There isn't like a staking or there isn't a governance mechanism that allows that revenue to flow back to token holders. So it's one of the things that bugs me about investing in some of these protocol tokens.
Yeah, and I'm just taking a look at the income statement for Aave, and they do generate positive earnings, so they generate revenue, which is great. you
Yeah.
know, and a lot of that revenue does flow back to Aave token holders in the form of buybacks, it looks like.
Okay.
Um, so it says here Aave starts to buy back Aave tokens using Aave Treasury after 9th April 2025.
What do they
Um,
do with those tokens? Do they burn them or?
that's a good question because I'm just looking over here at DeFi Llama data and it's not telling me whether they burn them or what they do, but their cash flows look to be very volatile, very, very volatile. This income statement goes back to 2021, and Aave was losing tens of millions of dollars per quarter in 2021, in the second half of the year, which is kind of crazy to see, man.
Oh, it's crazy to see because that's like it's all-time highs as far as token price.
Yeah, so the only thing that matters is not necessarily price, I guess. Um, But if I'm taking a look over here at Aave USDT, a big breakout today. So we are getting a breakout on a lot of these tokens. So Aave, and I'd be willing to bet that Tau is probably performing pretty well.
Well, it
Plus,
looks like in the past 24 hours, Aave went from it looks like about 114 at its low. Well, not its low, but well, its low was at 110, almost 111, and now it's sitting at 124.
yeah, I see it up at 124, and it did break out. It did break out above a level of resistance. So the next level of resistance for Aave comes in at 143. But we
Okay.
would really need to see Bitcoin and ETH continue to push higher in order for all of these alts to also continue to push higher. And I don't know, man. I mean, during a bear market, we should expect sharp, violent rallies that end up failing. That's the thing. And I think we're in a bear market. So that tells me that a rally like this is for selling.
Yeah, no. If if you bought at a lower price, yeah, definitely take some profits, wait for that pullback to buy back in, and and try to stick to that. You know, if whatever it is, that your risk tolerance is, if that's 10%, 20%, whatever it is, just try to ding, 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 and don't swing for the fences. Go for a base hit. It's
I think that's a good idea.
yeah, getting some good base hits, getting some people in for for some good positive scores on the scoreboard is better than swinging for the fences, and only getting the occasional win. So
So you see that comment in the chat there, Mike, about the Uni
yes,
token?
yes, I wanted to
So
get to that. And you
yeah. So I'm looking right now at Uniswap's income statement, and their cash flows are super volatile. I'm looking just at the bottom line at earnings, and it's just like unbelievably volatile. I don't know what to attribute all of this to. Um, it looks like in Q1 of 2025, net their earnings were negative 58K on $289 million of protocol revenue. And then in the next quarter, Q2 2025, uh, net net was negative 20 million. Okay, so you went from minus 58K to negative 20 million. And it looks like there was a massive incentivization program, I guess, of that exact figure, $20 million. And then the next quarter, Q3, another $10 million incentivization program, which brought net earnings in Q3 to negative 10 million. And then in Q4, another negative $1.8 million quarter. And it wasn't until Q1 of this year that we're starting to see some positive earnings out of Uni. But if you take a look at the Uni token itself, what type of yield does this thing actually pay? Like Does it
Well,
pay any
that
yield?
that was somewhat recent. They didn't used to pay anything, and I think, just with Aerodrome, the way that its tokenomics work, and I think they saw the growth of Aerodrome, and how it was kind of impacting and sucking some of their liquidity away. Because they changed that. So they made some changes to their tokenomics to where now some of that revenue that's generated from the platform is supposed to go back to token holders, if I'm not mistaken.
Yeah, they did. They I think it's called like a fee switch. I think that
Yeah.
they flipped the fee switch so that token holders can earn some of that revenue in some way. But those mechanisms are usually kind of vague or opaque. And it's like, okay, if you're going to hold the token, let's say
Hmm.
that the uni token, what's it trading for right now, Mike? Like three or $4, something like that.
$3.9.
Got it. So if let's call it $4. So if you've got one token at $4 and
Hmm.
you stake that token, I'm just assuming that there's a mechanism to stake these tokens. I have no idea if there is or not, but let's assume that you can. And you stake that token and you're earning 10% APY. Well, that's not worth it if the token goes down by 50% over the next 6 months. So, I mean, you really got to believe in the future of not just Uniswap, but you got to believe that they're going to be able to generate a hell of a lot more cash flow and that you're going to be able to earn more of that. Like, I view these as businesses. Like, Uniswap is a business,
Yeah.
and these tokens are not like shares of stock. They are
No.
not. They're more like Ponzi schemes. Like, for the vast majority of them, man, most of them are vapor, and Uniswap is not vapor, but it's still an alt. Like the Uni token, it's still a super high volatility altcoin, and that means you should expect it to move by plus or minus 50 or 70% each year, which is a huge move. So, yeah, I don't know that just that little bit of revenue that they make being returned to holders with that fee switch is enough. And so, yeah, he's in the chat. Uni token also has an unlimited supply, I believe. Yeah, I mean that it may be. I'm not positive about that.
Yeah, no,
Um,
it's right
yeah,
here. Max supply is two dashes. So yeah, there is no max supply. So unless they have a buy back and burn mechanism in there, to try to keep it at least equal or deflationary. It's I don't see a whole lot that would make me want to buy and hold this token.
no, sir, no, sir. Look, I think
You know,
that
not to hype my my bags, but Aerodrome, 100% of the fees that are generated by the platform go to people who lock, to provide liquidity. Anything that's not paid out to VE Aero holders is bought back and burned. It's
yeah, yeah. So you see the comment in the chat there, Mike, about
which
buying into the bear market being accelerated this time. Um, so that's a good question, but whenever I hear someone say something along the lines of, "Oh, you know what? This time it's going to be different. This bear cycle, it's going to be different because this, and this." I
yeah.
just think to myself, well, probably not. It probably won't be any different this time.
Mm.
And that means that we've got until October, November, like, of this year. We've got another solid 6 months of bear left. And yeah, the reason why, here's the reason why. Because, Crispy, for whatever reason, man, there is a Bitcoin cycle. I don't know why there is. All I know is that there is. And that cycle drives everything in digital assets. And so that cycle, according to the cycle, we're going to see the bear market trough for Bitcoin by October or November of this year. Because once a Bitcoin bear market begins and it's marked by 2 weekly closes below the 50-week moving average, so the 50-week moving average during Bitcoin bull markets holds as support. during Bitcoin bear markets, that 50-week moving average breaks and there's a close below it. That marks the start of the Bitcoin bear. Once the Bitcoin bear starts, you get usually 12 months of bear market. And so we are nowhere close to the end of the bear. In fact, we're in the early innings. We haven't seen capitulation yet. So capitulation would be like real fear and depression. We haven't seen that. We haven't seen accumulation yet. You might see the guys like Tom Lee at Bitmine talking about, hey, look, I got, 4% of the supply. I'm buying
Yeah.
all the ETH. And it's like, okay, that's great, Tom Lee, because you're going to be sitting on those bags for a little while, man. At least that's what I think. I think that he's going to be sitting on that $10 billion bag. It might turn into a $5 billion bag before the year is out, but he'll be able to sit through that. Same thing with Sailor.
Yeah.
Sailor's got plenty of cash on hand, man. He can continue to pay those dividends. He's got, no fear of getting like forced closed on his Bitcoin position. So he's not going to get liquidated or anything like that.
Well, we
And
covered that on Friday. That the fund, that he has, to basically as a slush fund to continue to pay those dividends. I think we figured that like at current rates, it was like 2 years worth or something like that.
right, plenty of time, man. He's got plenty of time.
He
Two
can wait it
years.
out.
Yeah, dude, that's an eternity in
Yeah,
crypto.
yeah.
So yeah, like, look, I would love to be able to buy Bitcoin like at 35K, man. If I could buy Bitcoin at 35K, and see, here's the thing, it'll be hard to buy it at 35 because if it gets down to 35K, you know what the news is going to be like, Mike? It's going to be like, oh my
Bitcoin's dead.
God, the world's ending.
Yeah, Bitcoin's dead.
It's dead. It's a scam. Like, it's going to
What were they saying the other
zero.
day? If you put $100 into Bitcoin every time that they were coming out saying Bitcoin is dead, you'd have like $43 million right now.
Yep, you just got to wait for that,
Yeah,
and so you don't want to buy it when people are talking about, oh, the bear market's over. That's
yeah,
when you don't want to be buying it. You want to be buying it when people are like really scared and
yeah,
that fear and greed index is like at the floor.
yeah.
And people are talking about, oh, well, quantum this, or it's going to get hacked that, or just like whenever someone says it's going to zero and it's a scam and it's a Ponzi, that's when you really want to be buying it.
A really good indication is when you see a lot of like crypto influencers disappear. When you start seeing like in mass, a lot of these people that were shilling, these projects and they're just basically they're ruined, because the prices have gone so low and they disappear off the face of the earth. And I could, the reason I bring this up is I saw a post where somebody was doing like the satirical monologue of like in moratorium, and it was showing like all the pictures of the different influencers coming up, and kind of where they where they are now and stuff like that. And I found it very amusing just because yeah,
It's just a shame, man.
yeah,
Like round tripping stuff like that and having too much in it, and basically being forced to liquidate your bags at the very bottom, because
yeah,
that's basically always how it happens. Like when you reach that point of max pain, that's exactly when you want to be buying, not
yeah,
dumping your stuff. So
exactly,
it's just so hard to do because our minds trick us, you know
yeah,
like we trick ourselves into thinking like, oh man, I've got to take action right now because it's going to zero. And guess what? When you feel emotion like that, what you should do is get up away from your screens and go do something else. Go touch grass, or get some sun, or do anything else.
oh dude,
So
I did it yesterday. It was a beautiful day out. I went out and chainsawed some, kind of toured my property, and went and saw like what trees fell during the winter time. And so I went out there with the loppers and the chainsaw, and just started kind of clearing everything up and cleaning stuff up and get some fresh air and the sunshine, and it felt good. It felt really good.
that's
But
good
let's hit
stuff,
this
man.
last news headline, and then let's start talking about some protocols. So
Sweet.
the last one that I got is upcoming data. The US ISM manufacturing, global PMIs, and more are coming out this week. So this week ahead includes the US ISM, which is the manufacturing, the PMI, services, and the jobs report comes out on Friday, plus China, Eurozone, and Australia data, potentially overshadowed by war developments. Producer prices rose more than expected in January. So,
That's
yeah,
inflation. Yeah, PPI. Yeah,
yeah.
that's the PPI is a pretty good leading indicator for CPI. Um, and basically, what Tom Lee and Raoul Paul have been looking for when it comes to like an extended business cycle is they're looking for ISM manufacturing to really pick up. That's what they've been talking about. So, if ISM manufacturing really starts to pick up and we don't see inflation start to pick up, that would be a good thing. But it looks like, I've seen recently, like, didn't the CPI, when CPI was released, I think last week, wasn't it a little bit hotter than expected? There was an inflation print, I think, maybe last week or the week before. But it'll be
I,
really, yeah,
I,
it'll
I,
be
I honestly don't know.
yeah, it'll be interesting to see, what the PPI looks like this week. Because hey, I see the VIX a little bit elevated. I mean, sitting just above 20. So if there's some type of inflationary shock,
That's the volatility index, right?
it is. It is.
Okay.
Yeah. So it's a pretty good measurement of. Oh, ding dong.
Yeah, yeah.
Yeah.
So I'll buzz through these real quick, and then we'll jump into talking about some Morpho and some Aave. So looks like global equity markets absorbing the impact of the U.S.-Israeli attacks on Iran. U.S. futures are down over 1%, and the European futures opening down over 2% from Friday close. Geopolitical escalation, oil sensitivity, VIX near 20, like David was just talking about. Looks like digital assets is definitely a risk-off tone, which means downward pressure. Fixed income, U.S. Treasury yield rose slightly from the low Friday close, with benchmark 10-year yield still below key 4% level. U.S. dollar surges, so the Dixie, as the clear safe haven among currencies after attacks on Iran, Norwegian kroner, higher on surge in oil prices. Commodities, the Brent crude rise $6 per barrel on U.S. Israel attack on Iran. Gold up over $100. What?
Oh
Gold up?
yeah.
Oh, I thought it meant like total, but it went up over $100 per ounce. I'm like, gold's way more. It's like over $5,000 an ounce. I'm
Yeah.
like,
Yeah.
somebody fat fingered that.
Yeah.
So
Gold's up there at 53.20.
yeah. No. Gold and silver are doing quite well right now. In fact, let me check on silver. Let's see.
Yeah, silver, 88 bucks. 88
Okay,
bucks for
so
silver.
it's down a little bit. It was up in the 90s. So yeah, I'm still sitting pretty on my silver. All right, so let's jump into some Aave. If you want to share your screen, David, let's walk everybody through some borrow and lending protocols. The two main ones being Morpho and Aave.
Awesome. Let's do that. Let me go ahead and get the right tab up here, Mike. And
So those
then,
those that don't know, this is our new format starting today, and we're just done with our first hour. So we got done with the news segment, and now we're going to transition over into our education kind of informational.
yeah, so this is actually from DeFi University content. So what I've got here is the Money Markets 101 course. And module 2 in here, we've got these 3 lessons. One lesson on Aave, another lesson here on Morpho, and a third lesson here on Euler. So these are the 3 big lend borrow protocols that if you're active in DeFi on EVM chains, you're probably going to be using. So let me just go ahead and bring up Aave, Euler, and Morpho real quick. And I want to go ahead and just share these tabs. So here's Aave. This is just the Aave homepage. Now, if you want to click on Aave for web, there we go. So now you should be able to see just the Aave core instance. You see this here, Mike?
Yep.
This is basically like the markets on mainnet on the Aave protocol. So you can see, okay, I've got 2.95 million ETH supplied and 2.75 million ETH borrowed. So Aave is the largest money market on EVM chains. I think it's also the largest money market period on DeFi. And you got a bunch of tether supplied here. You can borrow at 3.42%. So this is a large vault-based money market. Now let's switch on over here to Euler. Now Euler is a little bit different. It is programmable and permissionless, which means that you can build on top of Euler, which is really, really cool. Now, you can also build on top of Morpho, but Morpho manages at risk a little bit differently than Euler does. So Morpho almost requires that you use a curator to launch a vault or launch a product on their protocol, whereas on Euler, it's permissionless.
And one thing to understand about sorry about the glitches on my internet. I'm on Starlink. But one thing to understand about Morpho is it has been integrated with Coinbase. So any borrowing and lending of Bitcoin and now Ethereum on Coinbase is facilitated on the back end by Morpho. So want to put that out there.
Yeah, no, I mean, Morpho is a great protocol, and the fact that they use curators, it really does give users who are new to the space a little bit more comfort, I would say, just to know that, hey, my vault is being managed by someone who does this for a living. So that's a good thing.
Yes.
So why don't we go ahead and learn a little bit about Aave, a little bit about Morpho, and then we can learn a little bit about Euler, and then we can actually take a look at how these protocols function in practice. But I've got this video content here, Mike. Why don't we go ahead and play this?
Can't hear it.
Can't hear it?
No.
Okay, got it. Let me go ahead and give this one more try. I'm going to share that tab again, and I'm sharing audio, so it should work this time, Mike. Let me know if we can't hear this. Okay.
All right, let's talk about the biggest name in DeFi
Yep.
lending, Aave. Seriously, if you're looking for the safest, most established place to get your feet wet and start earning some yield in crypto, this is probably where you want to start. Let's get into it. So first, I just want you to look at this number, $70 billion. That's the total value of assets that people
$1
have
million.
supplied to the Aave protocol over its lifetime. It's just a staggering amount, right? It tells you right away we are not talking about some small experimental project. This thing is an absolute titan. And it's not just big, it is dominant. Aave commands roughly 60% of the entire DeFi lending market, the lion's share. That's why whenever you hear people talk about blue chip DeFi, Aave is always at the top of the list. It's the standard. So, why does that dominance even matter to you? Well, it's because Aave built that lead with a safety-first approach. It has become the leader by being one of the most audited, most battle-tested, and most trusted platforms out there. And that makes it the perfect place to start your DeFi journey. Here's the bottom line. For anyone new to this whole world, Aave gives you the clearest, safest path forward. It's backed by these massive liquidity pools, just gigantic pools of available funds, which makes everything more secure. And on top of that, they've built some really user-friendly options that hide a lot of the scary complexity. So how do you actually get started? Well, Aave gets that not everyone is a DeFi degen, right? So they give you two different paths you can take.
and you can choose the one that just feels right for your comfort level. And I love this analogy for their beginner-friendly option. Someone once called it the DeFi mullet. It's this clean, simple,
Right.
almost bank-like app experience on the front end, but in the back, you've got all that powerful, decentralized magic doing the work.
So
And
sexy.
here are those
Yeah.
two paths, side by side. On the left, you've got the Aave app. It's honestly perfect for just regular retail savers. Super simple mobile interface, and this part is huge. It comes with up to $1 million in insurance on your account. Then on the right, you've got the V3 dApp. This is for the power users, the people who want to tweak every setting and get full access to the protocol through a web browser.
Okay, so you know your options. Let's get practical. If you decide to go with the full dApp, there are a few things you absolutely positively have to understand to stay safe. Think of these as the non-negotiable rules of the road. The single most important thing to watch is your health factor. Just think of it like your safety score. The higher that number, the safer your loan is from getting liquidated. That's when the protocol automatically sells your collateral to pay back what you borrowed. If your health factor ever drops to 1, it's game over for that position. So your goal is to always keep this number high. Me, I like to keep it above 2.0 just to be safe.
Now, I really need you to pay attention to this slide. Aave has some incredibly powerful features for experts, but for anyone who's just starting out, they can be absolute traps. We're going to flag 2 advanced modes that you should just avoid, period. First up is E mode, or high efficiency mode. It lets you borrow up to 97% of your collateral's value, which sounds amazing, but you can only do it with super similar assets, like 2 different stablecoins. The risk here is just off the charts because a tiny little price wobble can cause an instant liquidation. Remember when USDC briefly depegged in 2023? That was enough to wipe people out. This is for the pros only.
Second is isolation mode. Now, this is used for listing newer, more volatile assets. It's actually a safety feature for the protocol, but it can be a trap for you. If the asset you're using as collateral starts to crash, you're not allowed to add a different, safer asset like ETH to save your position. You're stuck. You're
So
isolated.
this is
And that
something
is
that
a
we
really
need to
risky spot to
pause at for a second. So
Ah,
so here's the thing. When you're in E mode, okay, so E mode is efficiency mode on Aave. And you might think, oh, this is great. I can borrow so much more. It increases my LLTV. It increases the amount that I can borrow. But you can only do that with correlated asset pairs. And so if there's some type of market shock, then you're going to be stuck. You can get trapped in that position
yeah.
because you can only supply or borrow those correlated assets. You can't step in with stable coins and fix the position. You can't step in with another asset and fix the position. So you got to be really, really careful when you use that E mode over there on Aave. And just to understand LTVs and LLTVs.
be in when the market gets crazy.
Okay, so you're getting a handle on the Aave of today. But what's so cool about this project is that they are constantly pushing forward. So let's take a peek at the next big evolution, Aave v4, which is going to make the whole protocol way more powerful and efficient.
To get why V4 is such a big deal, you first have to understand the problem with V3. Right now, Aave basically operates as a bunch of separate, independent pools on different networks. One on Ethereum, one on Arbitrum, one on Base. All that money is fragmented. It's stuck in these different silos, and it can't be used efficiently across the whole system. And V4 is the solution. It introduces this brilliant new hub and spoke architecture. So instead of all those fragmented pools, you get one unified liquidity hub. This allows for way faster innovation, much better risk management. It's a total redesign that just makes the whole system smarter. And the biggest win from this new model, it's something they call 100% capital reuse. It means a single dollar that's deposited into the main hub can be used to support all the different lending markets, or spokes. It makes every dollar work harder, which should lead to better rates
It's a
and a
form
healthier
of
protocol for all of
leverage
us.
too.
Mm.
We've covered a ton of ground, the what, the why, and what's coming next. Now let's put it all together into a super simple, actionable checklist. This is your guide to setting up your very first Aave position in the absolute safest way possible.
Here it is, 4 easy steps. Number 1, start on a low-fee network like Arbitrum or Base so you don't waste money on gas. 2, supply a stablecoin, something like USDC, to avoid any price swings. 3, and this is the most critical step of this entire explainer, you have to make sure you toggle that use as collateral switch to off. And finally, step 4 is just to sit back, monitor your yield, and get comfortable with how the platform works. And here's exactly why we're starting on a network like Arbitrum. Just look at this chart. A single transaction on Ethereum mainnet can cost you $50, maybe more. That same transaction on a layer 2.
Okay, so this content I created last year, and so even last year, fees on ETH mainnet, it could be pretty high, especially when the network was very congested, like during periods of extreme volatility.
Yeah.
But they were not, even last year, especially at the end of the year last year, as Vitalik was raising the gas limit for all of the validators. The fees on mainnet were not $50. An average transaction was not $50. It was much, much less than that. But still, compared to the layer twos, we're talking orders of magnitude higher. And mainnet is very slow. So just keep that in mind, that it's not $50, the average transaction cost any longer, but mainnet transactions are still much, much more expensive than they are on a layer 2 like Arbitrum or Base. So
2 network, we're talking like 50 cents. For just getting started and learning the ropes, it's a no-brainer. And I'm going to say this one more time because it is that important. That little toggle switch is your ultimate safety net. As long as use as collateral is turned off, your funds cannot be liquidated. Period. End of story. It is the true zero-risk way to start. So let's wrap it up. What are the key things to remember? 1, Aave is the trusted leader in this space. 2, you've got 2 great ways to start, the super simple insured app or the full power D app. 3, the future is V4's hub and spoke model, which is going to make everything more efficient. And 4, the absolute safest way to begin is to supply stablecoins on a cheap network with that collateral switch toggled firmly to off. So now you really have a solid foundation for using the gold standard of DeFi lending. You get the rules, you get the risks, and you see what's coming next. But let me leave you with a question. Now that you've mastered the standard, what if there's an even more efficient, more powerful way to put your capital to work? We'll dig into that next time.
Sweet. Well, that was great.
We got a little bit of breaking news. So Aave just crossed 1 billion in deposits on Mantle.
Amazing. That's great. Yeah. So the Aave protocol. Why don't we go ahead and take a look at the Aave protocol? And I've got Aave open here. Let's go ahead and check out Mantle. So all I'm doing here, Mike, is I'm scrolling down through all of the different supported chains. Yeah. So I'm looking for, there it is, Mantle. Oh, wow. And there's an EtherFi market. That's so cool. Let's take a look at the Mantle chain. All right. Look at that. Total market size, 1.07 billion. And it looks like,
breaking news.
I know, right? And so it looks like you can earn 4% supplying USDT. But whenever you see this little like thing, what this little like icon next to the yield. So this is really important. As you start going through and using these different protocols, whenever you're looking at a yield number and it's got like one of these little icons right next to it, that means some type of incentive. So if I click on this,
basically boosted, it's not, it's something that can go away.
Right. So the real yield for supplying USDT is only 1.60%.
Okay.
So you're getting Aave wrapped Mantle tokens over on Merkle, and you're getting paid in that token. And that's the incentive, and that's what they claim boosts your yield up to 4.05%. But you've got to find out, like, are these tokens escrowed in some way? Can you immediately sell them? How long does it take?
That's very important. And this isn't just Aave. This is a lot of DeFi protocols. They'll have, hey, this is the APR that you can currently earn. But it's important to understand, how is that yield generated? Is it just simply using that token? Is it from Merkle, using a kind of a mechanism that works in the background? Is it attached to some other token that is much riskier? There's a lot of nuances that you need to make sure you understand before depositing liquidity into these vaults. So, sorry, keep
Yeah.
going.
Yeah, no, no, no. It really is important to understand that, because if you think that you're getting 4.05% on your USDT, but really you're getting 1.6, and then you're getting paid a bunch of these wrapped mantle tokens on the side, well, if you don't know that, then you're going to be wondering, where the hell is all my yield? So
Mhm.
just keep that in mind. I almost always prefer to just earn the native yield, and
Yeah,
I like to stay away from the incentives whenever I can. Usually the incentives are not worth it. Um, so yeah, I mean, this is the mantle market. Okay, great. Let's take a look maybe at the BNB chain market. I want to learn a little bit and see if there's any. So this is First Digital. Where? Oh my God, look at that, 10% supply APY. You see that? And this
yeah,
is not. There's no incentivization thing going on here. This is just
that's
straight
native yield.
yield. That's just yield. And so let's check this out. Why is it so high? I'm going to click on details. And so what I'm looking for
Can
here
you
is,
zoom in a little bit?
yeah, let me see. Let me see if I can. Is that a little bit better there, Mike?
A little bit better.
Kinda, sorta.
Yeah,
Okay, I think I can zoom in one more time.
there you go. That's
That's
perfect.
that's the biggest. Yeah. Okay. So what I'm looking for here, yeah, I know, right?
Keep going.
So yeah, so what I'm looking for here, man, is utilization. That's what I'm looking for. So to find that, usually you have to scroll all the way down. And here we go. Here's the interest rate model. So this it's called the IRM, and what I'm looking for here is the kink.
15%.
What?
Yeah,
So you see this kink right there?
yeah,
So that pink line, once utilization pushes above this kink, then the interest rates in this market go straight up.
yeah.
So you've got the utilization rate at 92%. And so that is what is generating this amazing supply APY of 10.56% right now.
They need liquidity because of that utilization rate. There's only like around 8% of the liquidity that's available for people to borrow. So,
Yeah, man. And take a look at how high this yield was, at the end of last month. Like,
well, I'd be willing to bet the utilization rate was even higher than it is now.
probably. And, it must have been. And it looks also like it stayed up there for a little while. So, all the way from basically, what is that, like the 24th to the 27th, you could earn well above 10% APY.
Well,
So
and
only a
this is
couple
why
days.
David always talks about time in a position is often better than just finding an APR that's like super high for a minute is you're not really gonna that's not really gonna be it's window dressing. It's not going to really make you money. Now if you get into a position to where you're earning 10% or more over time, that's awesome. But if you're making 30-40% for a week, but the rest of the time you're making 1% or 2%, it's really not going to make a huge difference in your portfolio. Whereas if you're just consistently making over 10%, then I mean that's going to treat you much better over time.
100%. And you don't need to be always swapping in and swapping out of positions. Really, I think that the best way to go about this is to become familiar with a handful of assets and follow those. Start following how ETH trades if you like ETH. Start following how Bitcoin trades if you like Bitcoin. If you're a Solana guy, then you gotta follow Solana. And you've got to become familiar with the biggest protocols on these chains. So that's why we're taking a look here at Aave first, because it's the largest money market on EVM chains. And here's the base market. So notice the Go token. Go is Aave's stablecoin. And you can earn right now 4.5% just single lending Go, which, that's not bad. But it gets even better when you start to loop this. So if you can earn 4.5% lending go, well then if you can find a market where you can borrow for less than what you're earning on the supply, you can loop that a couple of times and earn some levered yield. It doesn't look like there are any opportunities to do that right now, but I'm just scrolling through these markets. So here's Plasma. Plasma is an interesting one. This is a really fast, really cheap chain to use, but you can also supply PTs. So these are Pendle. These are basically like zero coupon bonds, which is pretty cool. Pretty cool that you can do that. You can also supply gold over here. So Plasma looks kind of interesting, $3.49 billion. And then the core instance, this is mainnet. So mainnet, ETH mainnet, the largest market by far, nearly $35 billion. And okay, we got, look at that supply APY for USDG, 20% there, Mike. So
Now,
if I hop in here.
What is USDG? I don't think I've ever heard of that one.
Yeah, I don't know much about this one either. It's relatively small. You know, we're talking about available liquidity of only $5.8 million.
Well, and I want to explain to people why I asked David that, because a while back, David was bringing up a very, very good point. Just because something is a stable coin doesn't, not all stable coins are created equal. Stable coins can depeg depending on how they're built out. So, before you just see a stable coin and you think, oh, it's pegged to the dollar, it's safe. You need to do your own research. You need to do your due diligence and understand, what allows that stable coin to keep its peg. So, again, not all stable coins are created equal. But go ahead, David.
No, definitely not. They're definitely not. So before trying to go after this 20% APY yield on USDG on Aave, you got to find out what in the world is USDG. Like, what is it backed by? Is it backed by treasuries? Is it backed by cash equivalents?
Is it backed by anything at all?
Right. It could just be made up out of thin air, like some type of fugazi. I don't think it's that. It's a fugazi. It's a fugazi. It's not real. But I think this is probably a legit one. I think this is backed by like treasuries or something.
Yeah.
So yeah, that's a little bit about Aave. Now, why don't we go ahead and bring it on back to the DeFi University course hub, and let's learn a little bit about Morpho. So this will be an interesting one. We can play through this about Morpho, and then we can actually take a look at Morpho and how to use it in practice.
Right. Today, we are diving deep into a DeFi protocol that's trying to completely rewrite the rules of lending. It's called Morpho. We're going to break down its super powerful engine, but more importantly, we're going to give you a practical, hands-on checklist to help you figure out if it's a safe and smart move for your own crypto. Let's get right into it. So let me start by asking a question, especially for anyone who's ever used a DeFi lending pool. Is your capital really working as hard as it could be? You deposit your funds to earn some yield, but what you might not realize is that a massive chunk of that money, it just sits there doing absolutely nothing. And that inefficiency, it's a huge hidden cost across the board in DeFi. And this is the fundamental problem that most of the big lending protocols have been dealing with for years. Think of them like these giant swimming pools filled with money. Now, to make sure you can always take your money out when you want it, they have to keep a huge amount of cash just sitting on the sidelines, totally idle. And sure, that's great for liquidity, but it's just a killer for capital efficiency and for the returns you could be getting. And this chart, wow, it just shows you how massive that difference really is. On protocols like Aave or Compound, you're often looking at a capital utilization of around 50%. I mean, let that sink in for a second. For every single dollar you deposit, 50 cents is basically on vacation, doing nothing. Morpho Blue was designed from the ground up to flip that completely on its head, aiming for over 90% utilization. You see, this isn't just a tiny improvement. It is a fundamental redesign of the entire DeFi lending engine. So, the big question is, how on earth did Morpho pull off this huge leap in efficiency? Well, the secret is really in its evolution. It started out as this really clever add-on to protocols that already existed, but it morphed into something way, way more powerful. A brand new foundational engine for the future of DeFi lending. So the very first version of Morpho was what they called an optimizer. It was this layer that sat on top of giants like Aave, and it very cleverly matched lenders and borrowers directly to give them both better rates. It was a huge success. It attracted billions, but it hit a ceiling. It could never be bigger or safer than the protocols it was built on. So the team went back to the drawing board and built something completely new, Morpho Blue, a standalone, unchangeable, and just hyper efficient lending machine. Honestly, this quote is the perfect way to grasp the massive leap that Morpho Blue represents. It's not trying to be a bank. It doesn't sit there and decide what's risky or what the interest rates ought to be. Instead, you should think of it like your computer's operating system, like Windows or Mac OS. It gives you the most basic, bare bones functions of lending and borrowing, and then it just gets out of the way and lets anyone, literally anyone, build their own apps, their own lending markets right on top of it. And this is the core innovation right here. It's called a decoupled architecture. What this means is that all Morpho Blue does is the simple raw accounting of who lent what and who borrowed what. That's it. All the really complex subjective stuff, like managing risk, picking a price feed, setting interest rates, all of that is handled by a totally separate layer that's built on top. And here is why that separation is such a game changer. Every single market is completely walled off from the others. So if someone creates a new super risky market for some random token and it completely blows up, well, all that damage is contained right there in that one market. It has absolutely zero impact on the blue chip USDC market running right next to it. This is a massive, massive step up for security compared to the old monolithic pools, where just one bad asset could spark a crisis for the entire protocol. Okay, but all this permissionless power creates a brand new problem, right? If anybody can create any market they want, how does a regular user like you or me navigate that jungle of options without getting totally lost? Well, that's where the next layer in the ecosystem comes in to save the day, Metamorpho Vaults. Exactly. A system where anyone can build is incredibly powerful, but it's also incredibly overwhelming. As a user, you don't have time to research thousands of different markets with different risk parameters. You just want to deposit your USDC and earn the best possible yield safely. It's that simple. And the solution is actually beautifully simple. Metamorpho Vaults. The easiest way to think of them is like mutual funds, but for DeFi lending. You just deposit your money into a single vault, which, by the way, is built on a really common token standard called ERC4626, and a professional manager who they call a curator does all the hard work of allocating that capital for you
Right. That's
across
the
many
important thing
different
to know.
Morpho Blue markets, all based on a clear public strategy. You know, this creates a whole new marketplace for something people are starting to call risk as a service. When you deposit into one of these
It's kind
vaults,
of like
you're not
mutual
just
funds.
trusting Morpho's code anymore. You are actively choosing
A
a
lot
professional
steadier of
manager. You're
yield
putting
that
your
can
trust in a firm like Gauntlet or Steakhouse Financial to make smart, calculated decisions with your money.
two of
And
the
that
large
brings us to what might be the single most important part of this whole explainer. Because you are handing over trust to a curator, you absolutely need to have a framework for doing your homework. So we are going to walk through a simple 5-point safety check that you should use every single time before you even think about depositing into a vault. Okay, first up, look for a guardian. This is a critical safety net. It's a separate group that can hit the brakes and veto the curator's actions if something goes wrong. Second, is there a time lock? You want to see a 24 to 48-hour delay before any big changes can be made. That's your window to get out if you don't like what you see. Third, look into the curator's track record. Are they legit? Do they have a history of being transparent? Fourth, check the idle liquidity, which we'll dive into next. And finally, please actually read their public risk report so you really understand their game plan. Now let's talk a little bit more about that idle liquidity, because this is probably the biggest operational risk you face. If a vault has 0% idle liquidity, that means
Liquidity.
every single dollar is lent out, and you literally cannot withdraw your funds until a borrower decides to repay. As a rule of thumb, you should only really be depositing in vaults that consistently keep over 10% of their money as idle cash. That's your buffer to make sure you can get your money out whenever you want it. So, to boil it all down, these are the huge red flags you need to watch out for. If a vault has no guardian or no time lock, for me personally, that's an immediate deal breaker. If their reports are vague, or if they suddenly start shifting money into way riskier markets without a really clear reason, well, that's a major sign that you should probably pack your bags and take your funds somewhere else. Okay, so with that whole safety checklist in your back pocket, let's zoom out a bit. How do you actually decide if Morpho is the right tool for you right now? Well, this direct comparison should hopefully make that decision a whole lot clearer. When you put Morpho Blue right next to a monolithic protocol like Aave, the differences are just fundamental. You've got isolated markets versus pooled risk. You have permissionless creation where anyone can build versus a slow bureaucratic DAO process. And the numbers, they really speak for themselves. Over 90% capital efficiency, and it's around 70% cheaper to use.
Yeah.
That's all thanks to this hyper optimized singleton design, which just means all the markets run through one single, incredibly lightweight smart contract.
It's
So
important
the
to
takeaway here is
understand
pretty
this
clear.
because that's
Morpho
what
is
really
fantastic
what's
for people who
allowed
are chasing.
Morpho to capture as much market share as it has from Aave. And those that don't know, there was quite this little back and forth, a couple months ago between Aave and Morpho, where Aave was trying to, basically trying to stop the hemorrhaging of a lot of the liquidity that was moving to Morpho. Because, especially in the market that we're in right now, the overall DeFi markets, have pulled back quite a bit as far as, the available liquidity. So, there's a little bit of a battle going on there. So anyway, sorry, go ahead.
Liquidity.
Liquidity.
Higher capital
Liquidity.
efficiency and who are comfortable doing a little homework to pick a professional curator they trust. On the other hand, it's probably not the best place to start for an absolute beginner who just wants the simplest, most hands-off experience and isn't quite ready to take on that extra layer of curator risk. But why does any of this technical jargon even matter? At the end of the day, it comes down to one thing: yield. Because Morpho keeps over 90% of its capital working hard instead of just 50%, it can offer much, much better rates to lenders. For the exact same asset, with the exact same level of demand from borrowers, a Morpho market can generate about 1.5% more in APY. And that right there is the real world cash in your pocket impact of having a more efficient engine. Which really leaves us with this final massive question. Morpho represents a potential future where the core plumbing of finance is just this decentralized, immutable utility, and risk management becomes a competitive, professional service that you get to choose. So the question is no longer just which protocol's code do I trust? It's now which curator, which team of people do I trust to manage my capital? And
Right.
that, my friends, is a whole new world for DeFi.
All right. So let's go ahead and take a look at those Morpho vaults.
Well,
And
really,
let's
really quick before we do that, I want to share a little bit about Morpho and do a shameless plug for our new X account. So,
Sweet.
we're here on X. If you want to follow us, it's at the Node channel, and this is our official account. But I want to go through a little bit about Morpho just from their account, their posts. So Morpho Vaults version 2 is a new open source standard designed to power the future of asset curation. We got BTC-backed credit markets will soon emerge. So Alpin Labs envisions a BTC credit market with market structure, fixed-term lending, secondary markets, and standardized loan claims powered by Morpho fixed-rate markets. You've got real PMF never showed any sign of growth decline during any market condition. So this is, basically the active collateral for Coinbase Borrow. So
Wow.
again, Morpho is, our Coinbase's Borrow and Lend is in the background, facilitated by Morpho.
Did you
And
see
then,
the size of that? That market's really big. What is that? 1.5 billion?
over 1.5 billion. Looks like starting to approach 2 billion.
Wow.
So, and then last but not least, from Token Terminal, Vaults. Morpho hosts two curators, each with over 1 billion in deposits. That's the Steakhouse Finance at 1.6 billion and Gauntlet at 1.2 billion. So just wanted to kind of give you a little bit of insight into that. And again, a shameless plug to follow us at the Node channel.
That's right. All right. So let's go ahead and take a look at Morpho a little bit. So this is the Morpho app. And now what I want to do first is just scroll down here, take a look at some of these vaults, right? So I clicked on the Earn tab up top here. And let's go ahead and sort by liquidity. There we go. So now we've got a handful of vaults here with a lot of liquidity. So let's take a look at Gauntlet, because Gauntlet is and Steakhouse. These two,
Are
these
the two
are
that we just mentioned.
yeah. Well, they're curators that are well known. So
Yeah,
if we take a look at the Gauntlet USDC Prime Vault, it's going to pay you a big fat, basically nothing, 2.8%. But
yeah.
that's not the point here. All I want to do is I want to scroll down and I want to take a look and see what does this vault hold. So its market exposure is CBBTC USDC. So it's basically mostly exposed to some type of Bitcoin. Uh, you know, I'm not quite sure exactly what they're doing with this, but it looks like they're generating yield on Bitcoin here. This looks like a levered loop to me. So I would probably pass on this particular vault.
Do
Why
you
don't we
mind
go
really,
ahead?
really quick, just very briefly, kind of explain to the audience what a levered loop is?
Sure. So a levered loop is it's probably easier if I hop on over here to Euler, the next protocol that we're going to take a look at to explain levered loops. So here's Euler. And in fact, why don't I just go ahead and share a real position that I've got on right now on Euler on the plasma chain. Let's go ahead and just take a look at that. That way we can see it in practice. So if we hop on over here to my portfolio, I've got this one position open right now. This is a levered loop. So how is this structured? Well, this is my collateral position, this SUSDAI PT, which is going to mature in about a little bit over 2 weeks. And so I'm actually earning quite a bit more than this 8.46% on this PT. I'm earning a fixed 12.5%. So if I'm earning 12.5% on my collateral and I can borrow up to 70% against it, that's the max LTV, then that means what am I going to borrow? Well, if I borrow USDT against my PTSUSD AI collateral and I pay less to borrow that USDT than what I'm earning, it's a net positive. So that what I'm doing here is referred to as interest rate arbitrage. So I'm supplying an asset that pays, in my case, 12%, and I'm borrowing a stable coin at 5.37%. So if I'm earning 12% and paying 5.3%, then I've got a nice little 7% spread.
Yeah.
So if I've got a 7% spread and I apply, a 3x leverage, then I can do 20% APY without even breaking a sweat. So if you
Well,
see up here,
and you're working with much more liquidity than you started with.
all the liquidity,
Yeah.
that's right. Well, all of it, all the liquidity. But you see up top here where it says my ROE, that's effectively my APY on my invested assets until maturity here. So this supply APY, my supply APY in this PT is actually quite a bit higher because when you swap into a PT token, you earn what's referred to as fixed state, fixed rate yield. So when I swapped into this thing, I locked in 12.5%. So I'm doing actually right now closer to 30% ROE on this levered loop. So all it is you supply asset A, you borrow asset B, you make sure that your interest rates are, friendly, that you're earning more on your collateral than what you're paying on your debt, and then you loop it up until you're comfortable with that LTV, and then you just monitor the position. So levered loops are a great way to earn really, really nice rates of return on stable coins. But you can run this using volatile assets too, although it becomes more of a stat arb at that point, statistical arbitrage. So we're not going to get into that today. In fact, I think what we should do now, Mike, is hop on in and learn a little bit about Euler. We gotta do some.
We got about 30 minutes left, so yeah, let's do that.
We got to do some layering over here on the Euler platform.
Can't hear it again.
Oh man, can't hear it again. Yeah, this This is my fault. I'm going to go ahead and share my screen one more time, and we're going to leer about some Euler. There we go. How about now, Mike? Is it working?
I gotta put it up on the screen. There we go.
Earlier,
You can hear it
and
though.
a pretty radical reinvention
Yeah,
that
you
might
can.
just be showing
Awesome.
us what's next for decentralized finance. So let's get into it. I want to start with just a number, a huge number, $197 million. Back in March of 2023, this is how much money was drained from the Euler protocol in one single devastating hack. But this number isn't just about a loss. It's the price tag on a very expensive lesson. The price of having a single tiny flaw in a big, shared, interconnected system. And it's the lesson that forced a complete from-the-ground-up rethink of how lending protocols should even be built. To really get what Euler is doing today with V2, we first have to go back. We need to understand what went so catastrophically wrong with version 1, because really, that failure is the key to its entire rebirth. So what was Euler V1? Well, it was super ambitious. It was a permissionless lending protocol, which meant it could list pretty much any asset out there. But its defining feature and its Achilles heel was that all those assets, the good, the bad, the ugly, they all live together in one single massive pool. This created what's called a shared state. The technical term for this is a monolithic architecture, but let's make it simpler. Think of it like a giant community swimming pool. Everybody's swimming in the same water. Now, if one little corner of that pool gets contaminated, let's say, they have to shut down the entire pool. Everyone is affected, right? That's the risk when everything is connected like that. And that is exactly what happened to Euler. A flaw in one single function gave an attacker the opening they needed. They figured out a way to basically create phantom debt, tricking the protocol into thinking it was perfectly healthy when it was actually insolvent. And because of that shared pool design, this didn't just affect one asset. No, it let them drain the entire thing. One tiny crack and the whole building came crumbling down. Now, here's where the story gets interesting. After recovering the stolen funds, which is a miracle in itself, the team didn't just patch the bug and call it a day. Nope. They spent the next 18 months rebuilding the entire protocol from scratch. The result is Euler V2, and it is a completely different beast. This table just lays out the change perfectly. You can see we go from a monolithic architecture to a modular one. We go from that scary shared systemic risk to isolated vault risk. So instead of one giant pool, we now have independent vaults where the health of one has absolutely no impact on any of the others. So what does this actually mean for us? It means Euler V2 basically bulldozed the community's swimming pool, and instead, it gives everyone their own private jacuzzi. If something goes wrong on your jacuzzi, well, that's your problem. It's contained. It doesn't splash over and ruin the party for everybody else. That is risk isolation in a nutshell. So, this new modular design, it isn't just about playing defense and being safer. It's actually about creating a super powerful, customizable toolkit for you, the user, to manage your own risk and build out completely unique strategies. The whole system is now broken down into different types of vaults. You've got your core vaults. Think of these as the blue chip, super safe section. Then you have the edge vaults. This is the Wild West, permissionless, for more experimental stuff. And there's even these clever escrow vaults, which let you post things like governance tokens as collateral without actually lending them out, so you don't lose your voting rights. Pretty smart. And on top of all that, Euler V2 gives you sub-accounts. Okay, imagine you have one wallet, but inside that wallet, you can create basically an infinite number of separate, sealed-off piggy banks. You can put your conservative, safe savings in one piggy bank and your risky, degen trading funds in another, and they are completely walled off from each other. Let me give you a real example. Using these sub-accounts, you could create account A. Super boring, super safe. You're just putting in 10,000 USDC to earn some steady yield. Low risk. But at the exact same time, under the same wallet, you spin up account B. This is your high-risk account where you're using some ETH as collateral to borrow stablecoins for some aggressive trading. And here is the magic. If that risky trade in account B goes sideways and it gets liquidated, your safe, boring savings in account A are completely 100% untouched. They are in a totally separate, sealed container. This kind of granular risk management just wasn't possible before in this way. It's a game changer. Okay, so all this power, all this customization, it comes with a bit of responsibility, right? So let's talk about how to navigate this new landscape safely, especially if you're just getting started with it. So the very first thing you need to understand is the difference between these two types of vaults. You've got verified vaults, which are curated by professional risk managers. They can adjust things if the market goes crazy. Then you have ungoverned vaults, which are set in stone. Their rules can never change. For beginners, the recommendation is crystal clear. Stick to the verified vaults. Stay in the shallow end of the pool, or a jacuzzi. And before you put a single dollar into any vault, just run through this super simple checklist. Is it verified? Who's managing it? What price oracle is it using? Is it trustworthy? And do you actually understand the risk parameters like the loan to value? A few minutes of checking this stuff can save you a world of hurt down the road. All right, so let's just boil this all down. What are the key takeaways? First, Euler V2 is a total security-first rebuild. Second, the big idea is the shift from that one shared pool to isolated vaults, our jacuzzis. Third, sub-accounts are your personal tool for separating risk. And finally, all this customization is awesome, but it means you, the user, have to do your homework. And that kind of leaves us with this one big, thought-provoking question. Euler has basically bet the farm on this idea that users want total control, that they want this granular, build-it-yourself risk management. It's a huge move away from the old one-size-fits-all model of early DeFi. So the question is this level of customization and isolation the blueprint for the future of DeFi? Honestly, only time is going to tell.
You know, I gotta say, I really do like Euler. Euler is a great protocol. It's really easy to use. And if I just switch on over here to this screen, let me just make sure that this is coming up properly. Mike, can you see this at all?
No,
Nope.
shared.
Yeah, this software sometimes doesn't really work all that well. So let me go ahead and share it one more time. And I want to hop in here to this tab. There we go. So here, let me stop that screen share again. I want to bring up just the tab. So that way we can take a look just at this tab. There we go. So that should be working now.
Then we can bounce back and forth.
Awesome. So here, let's hop on over here to the Earn tab. Now, once we're in the Earn tab, you see in the top right here, I've got this chain selected. In fact, I want to go ahead and just disconnect from the protocol. I've got Plasma selected. And yeah, there might be some opportunities here on Plasma, but that's not really where I want to be. Let's take a look at Mainnet. So on ETH Mainnet, this is going to be most likely the largest market. So I'm on the Earn tab, and I can go ahead and hit Supply. So I'm sorting by Supply APY. Looks like I can earn 3.5%, but there's very little liquidity in this vault, only 143K. I'm going to go ahead and move on from the Earn tab. Let's take a look at strategies. Okay, so most likely these are just going to be like automated strategies. So I want to go ahead and select my collateral asset. I probably want to supply, maybe some type of stable coin. So I'm going to go ahead and see, oh, you know what? Look, I can supply PTs here. That's pretty cool. The debt asset, probably want to, borrow some type of stable against it. Let's just scroll down and see what type of yields we could be looking at here. Oh my goodness, 297%. So yeah, well, you gotta check in on this because you see the little stars there.
Yeah,
that tells me that you're earning a lot of incentivization tokens. So you're earning the REUL token most likely. So if I click on View Details here, it's telling me the max ROE is 297%, but so borrowing at 11%. And there's that rewards APY. Okay, the collateral. So the collateral here, so here's the thing. You've really got to know what in the world YNUSDX is, So it says here.
Probably Yearn Finance.
It says Yield Nest. So Yield Nest Max Vaults. Yeah, so if you don't know what that token is, then you should not be in this pair. You should not be chasing, some massive APY. You've really honestly got to know.
When I see a massive APY or APR, to me, it's a red flag. It's, you can definitely, play with those with very very small portions of your portfolio. But I prefer to earn like a steady 20 to 50% APR APY on good solid assets, and and DeFi positions that aren't incentivized with shady, not shady, but just less established tokens.
Yeah, well, I mean, the red flag for me is you see the supply APY is only 6.87%, but the borrow APY is a massive 11.72%.
Yeah.
So the only reason why this is even positive is because of the rewards here. So these rewards are what get you that max, ROE up near 300%. So I would really pass on that.
Yeah.
So this is kind of cool. We got Euler Institutional coming soon. Wow, interesting. Okay, so let me go back to borrow. Let's go back to the borrow tab here. And I've got
I
this.
think we're going to be seeing a lot of institutional, vaults and institutional, offerings like on a lot of these platforms if they're going to, survive. Because I mean, that's where everything's going. Everything's going to regulated, institutional, money, institutional, curated, funds and vaults and whatever you want to call them.
Well, I mean, Mike, so this actually looks pretty interesting to me. If you're really bullish on ETH, then this loop here could work for you. Supplying RS ETH, which is an ETH LRT, supplying that at 5%, and then borrowing against it, wrapped ETH at 2.25%. If you apply max leverage, which I don't think is a good idea, but like,
But you do you.
yeah, you do you. You could be a degen if you want to, and you could earn 37% here, and something similar here. Frontier Puffer ETH, another LRT, borrowing wrapped ETH. So 4% on the supply, but only 1% on the borrow. And you apply max leverage of nearly 10x, you can get to 31% APY. So that's not bad either. And then this might even be a better opportunity because these are both ETH LRTs. So RS ETH and Lido wrap staked ETH. So if you earn 5% on your collateral and you're paying 2.49% on your debt, and you apply max leverage, you can get up to 28% APY. That's not bad, but maybe what you want to do is earn yield on stables like USDT and USDC. So because of this massive leverage that you can run here, that means that if you're only earning 5.79% on your USDT supply and you're paying 4.39% on your USDC borrow, well, if you apply that 16.65x max leverage, then you can get up to 27.61% APY.
So what would be the
pretty
risks
good.
of that? Because I mean, they're both stable coins, very well established stable coins. But I mean, is there, even stable coins fluctuate. And so, like, what would be the risks involved with doing something like that? Because most people would see that and think, oh, it's, USDT and USDC, they're both stable coins. So that's 100% safe.
Yeah, the biggest risk here is interest rate risk. If your borrow APY on the USDC spikes or your supply APY on the USDT dumps, then if you applied max leverage, then this positive APY could become negative in a hurry. So that's the core risk is interest rate risk. But you've also got DPEG risk. I mean, don't forget what happened in 2023 when Silicon Valley Bank blew up and USDC Circle, they had like $3 billion at Silicon Valley Bank. And so when the bank blew up, USDC depegged to the downside by 15%, while USDT depegged to the upside by like 6 or 7%. Now, here's the thing though. If you had been in this levered loop with USDT as your collateral and USDC as your borrow during that depeg, you would have done extremely well because the USDC, that's your debt token. So if USDC depegs to the downside as your collateral depegs to the upside, well, you just made free money. Like that's what you want to have happen.
Mm.
So, but that's still a risk because it could have happened the other way. Like it could have been that, maybe Tether had a bunch of cash at SVB or something, and
So
they depegged to the downside.
So my next question would be if that interest rate arbitrage that basically that it's doing, if that ends up moving against you, is there any risk of say liquidation or losing your assets or anything like that?
Yes, if you let it run like that for too long, sure. So in
Well,
this,
I mean, it would be a hemorrhaging, it'd be a
right?
bleeding of your liquidity, but there's no instantaneous, you hit a liquidation level, all of your liquidity's gone.
Nope. Nope.
Okay,
That would be during a real serious depeg or a small depeg, but you ran a ton of leverage. If you
gotcha.
run a ton of leverage and there's a relatively small depeg event, you could end up going to zero. So yeah,
So
gotta be careful.
basically the summary of what we just went over is these positions are not fire and forget. You don't enter these positions with leverage, and do these loops and then just go on about your merry way and don't check on it for days and weeks and months and these sorts of things you need to keep your finger on them. You need to be checking on them at least once or even more than once a day, just to make sure that that interest rate arbitrage is in your favor, that you're not hemorrhaging your profits basically.
Yeah, I think it's a good idea to check on these types of positions, once a day,
Okay.
just to make sure that everything's doing okay. Um, but yeah, Euler is probably my second favorite money market next to Aave, just because Aave I view as like the gold standard, very safe. But
Mhm.
Euler, you can do all sorts of cool stuff here. It's permissionless, which means that anyone can build on top of it, and that is really really cool. Because look, you can build on Morpho, but it's not permissionless. You need to get a curator to be able to build. So I prefer Euler over Morpho, but I really prefer Aave just because of its track record. Safety and trust is super important in this space. So, Mike, with the last 8 minutes that we've got, you want to go through some of the newest stuff that I've produced, because this is some next level stuff, man, about
All right,
Lightning.
let's do it.
Yeah, it's kind of cool, man. Let's check this out. So I want to share this tab. And I put together this research last night. And what I've started to understand about Lightning is that the Lightning channels create this structural leverage where a node operator can deploy one Bitcoin onto his node. And because of the way that the channels work, that one Bitcoin can facilitate, tens of millions of dollars in nearly instant Lightning payments on that channel, on that node that the operator opens. And so because of the channels, the way that the channels work, Lightning actually has like built-in structural leverage, kind of sort of like a shadow banking system. So I put together some research on this and I want to share it with you guys. I think it'll be really interesting. Let's check this out.
Today, we're diving into the
Let me know if you
paradox
can hear
right
this,
at the
Mike.
heart of the Bitcoin
I,
Lightning Network. It's this engine of incredible financial power. But as we're about to see, the very thing that makes it so powerful also makes it surprisingly fragile. Let's get right into it. Okay, so let's just start with this number because it almost seems like a typo. The Lightning Network has about 5,600 Bitcoin locked up as its foundation. But on top of that pretty small base, it's moving over $1.17 billion in payments every single month. How on earth can a system move that much value with so little collateral? That is the big question we're going to unpack. Now, to really get Lightning, you have to understand the problem it was designed to fix. You see, for all its strengths as a store of value, Bitcoin's main network, its base layer, it's just not cut out for, buying a coffee. It's way too slow. We're talking minutes or even hours for transaction, and the fees can be way too high for small everyday purchases. And that's where the genius of the Lightning Network comes into play. It's what we call a layer 2 solution that's built right on top of Bitcoin. You can think of it like an express lane for payments. It was designed to finally deliver on that original promise of Bitcoin as a true peer-to-peer electronic cash system. Payments that are basically instant and cost almost nothing.
So, how does it manage that incredible leverage? Well, it all boils down to this concept of structural leverage. Now, this isn't financial leverage in the traditional sense. It's not about creating debt or printing money out of thin air. No, this is all about using clever cryptography to make a fixed amount of capital work incredibly hard, multiplying its usefulness over and over again.
The
Right.
secret sauce here is something called a hashed time lock contract, or HTLC. It's a piece of cryptographic magic that basically works like a self enforcing smart contract for your payment.
And they
It
moved on
creates
to
this one simple,
PTLCs.
unbreakable rule. Your payment will either get to its destination perfectly, or it will boomerang right back to you. There's no in between, and absolutely no risk of someone in the middle just walking away with your money.
And this is the perfect way to see how it works. So let's say Alice wants to pay Carol, but they don't have a direct connection. They are, however, both connected to Bob. Alice uses one of those HTLCs to send a payment to Bob, but it's locked with a digital secret that only Carol knows. Bob sees this and knows it's totally safe to go ahead and forward his own money to Carol. Why? Because the instant Carol claims her payment from Bob by revealing that exact same secret automatically unlocks the payment from Alice to Bob. It's like a trustless chain reaction that can ripple across the entire network. What's really fascinating here is how the network's use has evolved. We've seen this absolutely explosive growth of over 1,700% in the average transaction size. This tells us it's not just for tiny micropayments anymore. The Lightning Network is now being used for serious, high-value settlements between big exchanges and institutions. It's really growing up.
But this is where the story takes a really sharp turn. Because the network we have today, it looks nothing like the one its creators first imagined. It didn't evolve based on some grand philosophy. It evolved based on the cold, hard logic of network theory and mathematics.
Their original vision, well, it was beautiful. The idea was this totally decentralized mesh, a flat, peer-to-peer network where thousands of small, equal participants would route payments for each other, creating this truly distributed financial system without any central points of control.
But the reality looks like this. It's a classic hub and spoke system. And the numbers are just stark. The top 10 nodes on the entire network now control a staggering 85% of all the public capital. So instead of a decentralized mesh, we've ended up with a system that funnels through just a handful of massive, highly connected hubs. So why did that happen? Well, it comes down to a principle from network theory called preferential attachment, or, what we'd call the rich get richer effect. It just makes sense. If you're a new user, you're not going to connect to some random small node. You're rationally going to connect to the biggest, most reliable hub you can find to make sure your payments actually go through. And when every single user makes that same logical choice, it mathematically guarantees that the biggest nodes just keep getting bigger and bigger.
Right.
And you can see this consolidation happening right here in the data. Between 2023 and 2025, the number of public channels got slashed almost in half, from 80,000 down to just over 41,000. But look, the total amount of Bitcoin locked in the network actually went up. This points to a massive trend of professionalization. The small hobbyist channels are disappearing, and all that liquidity is being sucked up into fewer, much larger, professionally managed hubs. So this professionalization has created a whole new class of player on the network, the liquidity service provider, or LSP. These are the companies running those massive routing hubs at the center of everything. They've effectively become the new indispensable middlemen of the Lightning Network. And the data here is just undeniable. The Gini index, which is just a standard way to measure inequality, has shot up to over 0.95. For context, a score of 1 would mean total centralization in a single entity. And as we saw, the share of capital held by just those top 10 nodes has jumped from less than 50% to around 85%. The network is absolutely consolidating around these huge players.
Yeah.
So how do these hubs stay on top? Well, they build powerful competitive moats around their businesses. They have deep pockets for capital and sophisticated liquidity management. They use advanced tech like splicing, which lets them manage their capital more efficiently. And they're even expanding their business to route other assets like stablecoins, basically turning themselves into modern multi-asset clearinghouses. This brings us to a really, really important distinction. The Lightning Network is absolutely not fractional reserve banking. It can't create credit or money that isn't there. Every single payment is 100% backed by real Bitcoin locked on the main blockchain. A much better way to think about it is like a shadow banking system. It doesn't create new money, but it acts like a financial clearinghouse, maximizing the utility of its locked capital to provide liquidity and settle huge volumes of payments. And that leads us to the final critical piece of the puzzle, the paradox. All of the centralization, all of this leverage, it has made the system unbelievably efficient. But that very same efficiency has created a new and potentially catastrophic kind of fragility. Because the network is so heavily concentrated in just a few major hubs, it's now vulnerable to systemic shocks. A targeted attack on a major node, a sudden spike in Bitcoin fees, or a liquidity crunch at a key player could trigger a domino effect, a cascading failure. A problem at just one of these hubs could spread like a contagion, potentially freezing up payment routing for the entire network. Its greatest strength, that structural leverage, is also its greatest weakness. So we're left with this lingering question. The Lightning Network's leverage makes it one of the most powerful and efficient payment systems ever created, but that same leverage also makes it incredibly fragile. As this network grows and becomes a more critical piece of our financial world, the ultimate challenge is going to be this. Can its resilience possibly keep up with its own amazing efficiency?
Wow. Very interesting, Mike. Very interesting. So I hope that that was valuable for everyone. What did you think?
I enjoyed it. I mean, there was a lot of really good information, as far as, the news and the, different protocols, and, just kind of doing a very, rudimentary, but introduction to some of these, platforms, just that I know that we use on a somewhat daily basis.
Yeah, man. You like getting those Satoshis? Those are pretty good, huh?
Well, we need to do, like I said, more shows where you send me sats,
Yeah.
just regular basis. I don't think it's really sinking in with the audience.
Ah, we gotta do it some more.
It's all about repetition.
Oh man. Good stuff, Mike. This was a great first show, man. It's only gonna
Absolutely,
get better from here.
absolutely. Well, I tried to while we were listening to that, I tried to create our YouTube channel for the node, and of course, YouTube is still saying that we're not eligible to, with the new email. So I'll keep trying. Once that happens, that's going to be the only place. I'll make sure that we put it out on a couple of shows. But our YouTube channel, once that's up, all the node socials is going to be the only place to watch this show. We're doing that just so that we can kind of consolidate for analytics reasons. That allows us to be able to get more granular with our data and understand what's working best to help grow the channel. So, David, any closing thoughts before we close this out?
No, Mike, I think I'm good to go, man. I'm just looking at markets and watching Bitcoin and ETH, pull back a little bit from their highs of the day. I see the S&P and the Nasdaq. They were green just briefly. The futures have turned red again, and really big bounce today. Really big bounce out of markets, man. So
Yeah,
it'll be interesting to see how things close over the next 2 hours. But hey, big bear market bounce in crypto today.
absolutely. And I just want to give a shout out to everyone in the chat. We got, it looks like 15 over on the arena and a couple of hundred, across all the different socials, and seeing some really great comments. I appreciate all of you that show up and ask questions, because a lot of the questions you put in the chat help us guide the conversation and ensure that the information that we're giving out is what you're all looking for, because ultimately that's why we're here, is to make sure that we give unbiased, unemotional, verified and checked information and news, because we don't just want to be sensational. We don't want to do clickbait. We don't want to do the clickbaity titles and the sensational thumbnails and all that stuff. We just want to give you good, solid information and education so that you can make good, solid decisions in your investing. That's it. So,
Well, 100%.
David, thank you. Thank you to everybody in
Thank
the
you.
chat. Till next time, Veteran Crypto out.
Peace.